Vishy, what is the distinction as we stagger to January? What are you watching most closely in your fixed income space?
I think, Tom, the most important thing I would say is that as we go into the year, this is the year of yield. This is the year of fixed income. We expect to see significant allocations, perhaps away from equities into the fixed income space. There's a broad range of fixed income assets that these flows could go into, and we think there is whether you look at on the institutional side with the pension funds or on the retail side on the household balance sheet, there's a significant room for greater increased allocation to fixed income securities. I think that's the biggest point here.
And you push against the media fixation on Fed discussion and yield. Are flows going to overcome all next year?
We think that is genuinely the case for flows to move away from equities into fixed income. This all lines up well with the way we think about at Morgan Stanley, with my colleagues in equities, equity research and economics. We think that the case for equities is weak. As you've seen, my colleague Mike Wilson mentioned quite a few times, the margin pressures and then more downside to come in earnings. And when you look at the fixed income world, we think that we are now in a point we are closer to the terminal rate. The key question for us is how long does the Fed, whenever the Fed stops hiking, how long does the Fed stay at those restrictive levels? But I think the one major difference this time and the previous several recessions or economic slowdowns that we've seen is that in all of those cases, we have seen credit defaults spike from a very low level on the back of recession or economic slowdown, something we do not expect to see this time. So you take that into account, and you also take into account that in other parts of fixed income, emerging markets, for example, a lot is already reflected in price. You put all this together, the case for greater allocation to fixed income is pretty strong.
You gave us a flavour of it then, Vishy. You said EM. Can you just build this out a little bit more? Moving away from equities to fixed income, big universe, where in fixed income?
So the easiest case to make is investment grade corporate credit. That's a pretty good case to be made. Spreads may be somewhat wider in a year from now, but we expect yields to be meaningfully lower. That makes a pretty good case for a total return for investment grade credit. In some parts of the high yield bond market, there are interesting opportunities where the bond yields in companies that have both stocks and bonds, bond yields are actually meaningfully above what the equity earnings yields are. That's a pretty good case to be made. In emerging markets, sovereign emerging markets, in some of the high yield space, what the market is pricing in terms of defaults compare that to the long-term average defaults we have seen under different rating category. Say in the case of BB bonds in sovereign in emerging markets, the long-term average default rates have been around 5%. The market is pricing between 19 and 24%. So that's a substantial risk premium there. There are lots of parts of securitized credit, mortgages, and others where there is still opportunity. So you put all this together, you do work on fixed income, there is a lot of places to put money to work.
Vishy, I heard a little bit of a quality bias there. Is there a geographic bias within that as well?
There is a little bit of that. I mean, I think it's a combination of the economy as well as what's already priced in. We think that the opportunity set in credit, for example, in Europe is a bit better than the US. And we also think there are other parts of the leveraged loan parts of the market we will be a lot more cautious on. So there is clearly a quality bias up in quality. And the canary in the coal mine is the markets that are interest rate sensitive in credit, which is in particular leveraged loan market.
Vishy, one final question. We were down negative 17% on the Bloomberg Total Return Index. Maybe we're down negative 12%. I don't need a Morgan Stanley call, but I need a Vishy call. How many years is it going to take to make back that loss if I'm clipping coupons?
So it all depends on what happens to rates. So we would say the last year investment grade credit, down 17-ish%, 17, 18%, as you mentioned. We have to that's a lot of that is entirely because of the rate move. Not spreads widened a little bit, but mostly was rate move. So some reversal of the rate moves, which we expect to see, will get to midway there by end of this year. So we are expecting something total returns in the 7% context by end of this year. And so we will. That's the kind of moves we are expecting to see.
Okay.